Grinnell Capital is a boutique asset management firm based in Park City, Utah.
Good morning. My name is Frank Grinnell. I've been investing in the stock market for over 20 years. It serves as my day job, and most importantly, it is my absolute passion. On Street Views, I offer my daily viewpoint on the stock market in under 7 minutes. I will cover things like the global macroeconomic picture, the mood of the market, company-specific news, secular trends with some actionable sector and stock calls. I hope my insights are useful to you, whether you are a professional money manager or a passionate investor. At Grinnell Capital, we share high-conviction ideas with subscribers, and we actively manage stock and ETF models for financial professionals and their clients, as well as individual investors. For more information, check out our website. Before we get to today's podcast, be sure to hit subscribe. And now, today's Street Views. Hey, good morning. Happy Friday. I guess TGIF, right? So rough day in the market yesterday. Bear market still intact. S&P 500, we can go back. We've done this. Downward sloping trend line, resistance, fail. Fail. Looks like we're heading right to, the 50 days are going to come into check here pretty soon. If not today, probably next week. And then we'll see what happens. So I think it's time. Honestly, the reality is we've had a good rally off of Q4. If we go back and look at October, November, since October, this market's up pretty good. So there's actually been some pretty good gains. So I think it makes sense to go back and look at some cyclicals. Why do I say that? I think that in general, those are some of the most vulnerable areas. They've had a huge run. So, right, see this, the industrials, huge lift off the lows. Definitely vulnerable to this 200-day, no question. And as we go further into 23, they might in fact break this and retest these lows. Who knows? So what I think makes sense is you go and look at some of the ones that may be on the expensive side. And believe it or not, something like GE is just as battered and bruised and beaten as this thing has been. 5-year chart, 10-year chart, 15-year chart. Anyway, you get the idea. General Electric, believe it or not, trades at 29 times forward earnings. Yeah, I was surprised too. That's expensive. It's expensive, and I think that the market's going to become a little more discriminating on valuation as this bear market continues to drag on and become an earnings-led bear market versus the interest rate-led bear market, which we've had so far. So Honeywell, which we own, we are long. We may not be long after today. But we've had a real good run. This thing has had a good move. This is a downtrend I wrote in there before. It still looks great technically, all that stuff. But I think it makes sense to at least trim. But Honeywell, 25 times forward. I think that's too expensive. Rockwell Automation, 28 times forward. Too expensive. I just think it is. Because think of that 28 times forward, that E for 23, unless you've got some real solid confidence into a weakening macro that E is going to remain intact, that 28 is actually higher. Does that make sense? So John Deere, another one. This is kind of more in the machinery realm. Obviously, Deere and Cat actually aren't that expensive on a forward PE, 16 times. So that's roughly in line. Let's call that a market multiple. So that's a little more encouraging. It's had gigantic run off the lows, but I just think this is time to be smart, trim. I think trimming makes a lot of sense. Good rally. We talked about the idea of having protection on a couple weeks ago. This is the VIX. We own the VIXY. We own this thing. VIX has been just a crappy trade all year. Volatility hasn't really gone anywhere. We bought this low enough that we're up on it, and we'll probably add. It's looking, maybe volatility finally starts to factor its way into the marketplace. It's up 2.4% pre-market as S&Ps are looking down almost 1%. So I think protection makes sense. If you don't do the VIX, maybe you write some calls, maybe you buy some index puts, something like that. I think makes a lot of sense. And we did buy some PSQ. So PSQ is the inverse triple Q. We can do that with our model. So PSQ lifting up, this thing looks good from a buy, lifting off the 200-day, going, looks like it wants to go higher. That's, obviously means the triple Qs are going lower. This thing tested, a downtrend line I put in here from the highs, and that's kind of a clumsy downtrend line. I don't know, but it's whatever. It is one. And you got them breaking down to the 50-day, and it's going to gap lower this morning, only off 48 bips, so not too rough. So yeah, assume bear market till proven otherwise, right? That's just where we are. So as we go into 23, today the dollar has been weakening. So right here, right now, today, Friday, December 16th, you may get a counter trend lift in this thing. Option expiration day, there's some big delta thing where it's, bull delta. So I assume that means, the dealers have more to cover and close out on the long side, so buying to close out positions than selling. So maybe you get a lift off this week open. That's an opportunity to lighten up and or put on some protection. There you go. Have an awesome weekend. Good luck out there today. Talk to you Monday.
And now for some important disclaimers. This podcast is intended for financial professionals only. Grinnell Capital LLC is a state-registered investment advisor located in Utah. Services offered by Grinnell Capital can only be offered in the states of Utah, Idaho, California, and Texas, where Grinnell Capital is registered or where otherwise legally permitted. Registration does not imply a certain level of skill or training. For additional information about Grinnell Capital, including its services and fees, please review the firm's disclosure statement as set forth on Form ADV and available at no charge at advisor.info.sec.gov. This podcast is provided for informational purposes only. The information contained herein should not be consumed, construed at the provision of personalized advice, and is subject to change without notice. This material should not be considered a solicitation to buy or sell any asset or engage in a particular investment strategy. Investing in securities involves the risk of loss, including loss of principal invested, and may not be suitable for all investors. Past performance is no guarantee of future results. This podcast contains certain forward-looking statements which indicate future possibilities. Actual results may differ materially from the expectations portrayed in such forward-looking statements. As such, there is no guarantee that any views and opinions expressed will come to pass. All expressions of opinion reflect the judgment of Grinnell Capital LLC as of the date of publication and are subject to change without prior notice. This podcast contains information derived from third-party sources. Although we believe these sources to be reliable, we make no representations as to the accuracy of any information prepared by any unaffiliated third party incorporated herein and take no responsibility. Therefore, this podcast is provided with the understanding that Grinnell Capital is not engaging in rendering legal, accounting, or tax services, and we recommend that you seek out the services of professionals in these aforementioned areas. The principal investment focus of the accelerator model, the strategy, is to achieve long relative and risk-adjusted returns, primarily by investing and trading securities issued by companies that focus on the global information technology, consumer healthcare, industrial, and infrastructure sectors. These sectors are characterized by robust secular growth potential and an abundance of both new and maturing product cycles, a field of competition that creates the potential for relative winners and losers within a subsector or theme, a high degree of revenues and earnings volatility, rapidly changing sentiment and public perception, significant yet unrealized potential for globalization, and superior relative liquidity. Investment in the strategy is speculative and involves a high degree of risk. The second investment model is called the ignition model. The ignition model is an all-exchange traded fund, ETF strategy, with an investment objective similar to the accelerator model. This model seeks to capitalize on long-term growth trends experienced by the market leaders in various areas and sectors. The ignition model will also seek ETF investments based on cyclical forces experienced in the U.S. and the global economy. This model is also designed to have the ability to offer some risk aversion in the event of significant market stress through investments and ETFs designed to take advantage of market volatility. The strategy's performance can be volatile. Grinnell Capital LLC has total trading authority over the strategy. The use of a single manager applying similar trading programs can mean a lack of diversification and consequently higher risk. For more important disclaimers, please visit our website, www.grinnellcapital.com.